Lindsay Reed, Managing Director of Minbos. We're growing a nutrient company in Africa. We're starting with a phosphate project in Angola, which is very, very important for their needs. Low capex, high return. Got a green ammonia project that'll come along and make nitrogen alongside that, and it's based on the lowest hydropower tariff in the planet.
Lindsay, good to see you. Welcome to London. Thanks. Here for a conference, which I think starts tomorrow, eh?
Yes.
Why are we here?
Post-COVID, story hasn't been got around the world very much. As you know, I was stuck in Angola for almost a year and a half. So we need to get out and tell the story. I haven't been to London since pre-COVID, so a lot of investors don't really know what we're doing, and it's pretty exciting.
Right. A nutrient company. That's a new one. What do you mean by that?
Well, we have a phosphate project which we can sell as a nutrient, as a direct application nutrient. So it's very, very cheap. We dig it, we dry it, we distribute it.
Okay.
And it just turns out that it's a perfectly suited P nutrient for Angola.
Okay.
And the biggest food aggregator will probably buy 80% of our product, and it's suited to their soils and climate. So a little bit lucky, but also good for the country, good for us.
And so what are the options out there for nutrient companies? Because, we talked to mining companies, and you're kind of, I guess, derivative of a mining company with your phosphate.
Exactly.
You dig it out of the ground.
Yes.
But nutrients suggest what to people? Different multiple?
Good question, because I don't know the comparable for us.
Yeah.
But
trying to work it out myself.
I do know that Angola sort of like imports 100% of their fertiliser, probably half of their food. They have a food security issue they have to solve, and they're putting a lot of attention into it, and they need phosphate first. And we just happen to have a little project with 8 million tonnes that we can keep mining and selling to them at fertiliser prices rather than phosphate rock prices, which is really helps the returns.
Okay, so I'm sure you'll kind of go on and describe it as a kind of domestic market first, and we'll work out what happens after that. But talk us about in terms of these nutrients. There's phosphate and there's phosphate.
Right.
So what have we got?
Okay, so your NPK are your big ones.
Okay.
They need nitrogen, phosphorus and potassium. In Angola, phosphorus is mission critical. If you don't put the phosphorus down, the N and the K do nothing, because it's very, very low in the soils, and the soils grab hold of water soluble. There's 2 types of nutrients. You can have citrate soluble, water soluble. Our phosphate rock has a very high proportion of citrate soluble, which means the plant can eat it. If you have water soluble, the plant can eat it, but also the soil can eat it, and the soils in Angola want to eat it and keep it. So that's why we have a competitive product.
Okay. And what are we aiming for first? I want to get to an economic discussion with you.
Excellent.
Okay, but first we just trying to lay this out for people who are new to your story, perhaps new to the space entirely. So you're going to focus on what product first, to which market?
So our first stage project, which is got a capacity just under 200,000 tonnes per annum, will sell into the domestic market to the domestic farmers, most of which are smallholders supported by this major food aggregator in the country, Crux. That will absorb all of our product, and we dig it up at 30% P2O5. We crush it a little bit, about half its size, and then we dry it, and then we distribute it. And we put about a tonne per hectare onto each farm at the start, and that actually lasts for about 4 years. And we're seeing that we're tripling the yields of the farmers just with that application.
Okay, so let's begin a process around economics. So where are your costs? Is it digging out of the ground? So a little bit of crushing is obviously not energy intensive, but there's going to be a need for it.
So the digging and transporting, the fixed costs and processing costs of the processing and the transportation are roughly about a third at this stage.
Okay.
And we are looking to double our capacity, then the fixed costs actually come down quite a lot, and we'd probably say $20-30 a tonne. So we are looking at probably $117 a tonne at this stage for a product that's worth on about 300. And the capex that we've got left to spend is about $24 million US. And
so let's talk margins, because that's what is that the final cost into market? So can I get
that's delivered cost to the destination port where the customer picks it up.
Right, and that you basically you don't have a kind of marketing cost per se. You're kind of wholesale effectively for these retailing.
We will sort of we will sell to this food aggregator who's targeting most of the smallholder farmers in the country.
Yeah.
And they're mission critical to it, by the way.
Sure.
But we will also focus on the larger farms, the bigger customers. So we've got probably 10 or so that we're targeting. But once they get down under 5,000 hectares, we're not really interested. So the biggest one is, we're targeting the biggest farm in Angola, which is 40,000 hectare sugar plantation.
Right.
Our product works really, really well there, so we'll sell directly to them. But the smaller farmers, we will go via the food aggregator and one or two other distributors.
Who all sell internally?
All sell internally.
Okay.
There's much better value for this product internally because in Angola, this phosphate rock displaces fertiliser. If we sell the phosphate rock into the export market, then it competes with all the other export rocks, and it doesn't really have that big of advantage.
Right, okay. And then the government obviously recently announced its preference for domestic
Correct.
versus import. It makes a lot of sense. But do they do anything for you if being
Not in terms
producer?
of tariff or revenue or
Credits,
anything like
tax,
that. No. So we do have a low income tax, a very, very low income tax rate in Cabinda, but that's because we're in Cabinda and they're trying to encourage development in Cabinda. It's not to do with the fact that we're fertiliser or anything like that. But otherwise, the government's just saying we want to encourage local production for local consumption.
Okay, so encourage and preference is not mandate. So what's the competition?
So the competition is we have to compete with imported product, and that's quite easy to do at the moment because the market is our size. So it's very, very difficult for the big suppliers to come into Angola because the market's smaller than the ship size they need to compete. Whereas we can tootle up and down the coast to the local ports with a 5,000 tonne vessel, which is really good for filling up boats and keeping us operating all of the time. So for the next 3 to 4 years, we have a beachhead that's pretty hard for other people to get over the top of.
Including the additional cost of shipping it over and just...
So we are pricing our product based
are...
on landed cost at the destination port compared to other products. So we're not offering a huge discount. What we are offering is the product will be there in their shed at the start of every season.
But you do have the ability to do that in terms of move that price according to what's going on in the market.
Yeah, we do. We've got a lot of...
No one wants to. You want to be making...
No. We're not being shy about that.
Okay.
It's actually very important for Angola that Minbos makes a really good return. And when we put tender in for the project, we said we'd like to make a better than 30% return. And it's important for Angola that Minbos is seen to be coming there with foreign direct investment, investing in facilities in the country, selling into markets in the country that create economic diversity and grow the economy and makes a return. Because, we've got free advertising with 2,000 shareholders and conferences. If we look good, then other people are going to look at Angola. So it's very important.
Okay, so that's the kind of buy-in from the government, and I say the beachhead is quite strong. Can we talk about how your company takes the next step? So we're going to talk about money, right?
Yeah.
So some debt. Is that
So we've got 24 million left to spend to construct this project.
Yeah.
The IDC from South Africa has given us a credit approval for 14 million.
Yeah.
We raised some equity a couple of weeks ago.
Yeah.
We've got some strategic shareholders that are looking at giving us the rest of the equity.
Right.
And the government, one of the other initiatives that the government has done is they've put in place some concessional funding for the local banks to fund the value chain in the agricultural sector. So there's 7% money available for working capital facilities to fill up that value chain in the agricultural sector, and we will take advantage of that.
Right, and the debt component, is it a case of needs must for now and you'll refinance it out later because it's LIBOR, or would it SOFR? 6.1 plus 1.75
for the sovereign, for the political risk insurance.
So is that good at the moment, or it's what we need now?
It's pretty good. It's also very strategic because IDC have also been the project financier for the Cabinda oil refinery. So they're familiar with the jurisdiction, they're familiar with Angola, and it's important again for Angola to show that you can project finance Angola. So it's a good source of money. Secondly, IDC have some strategic relationships. So one of their controlled entities is interested in buying more, essentially doubling the capacity of our plant and buying that for consumption in South Africa. So if that happens, then, as I said, our fixed cost will come down across the entire production suite.
Okay.
Their debt gets de-risked, their investment in their producer would get de-risked and things like that. So there's a strong strategic relationship with IDC and that debt as well. But, our payback looks like it's 2 years. So that debt doesn't look that onerous either.
So it's 5 years plus a 1 year holiday. Is that right? Okay, fine. Okay, so that's typically something just for when it gets refinanced out. So as closer you move to revenue, or once you're in revenue. So
Possibly. And one of the things that we're looking at is, we've done that financing simply on our first stage.
Sure.
The first stage will have a total capex of 40, even though we've already spent 16. To double the capacity of the plant, we only have to spend 4. I can go into why that is, but all the key equipment is capable of, was already capable of doing double that.
Right.
Because we were working on a recirculating flow sheet, which implies the flow sheet, and it only goes through once now. So things that had capacity of 500,000 tonnes but could only do 150 now can do 500.
It's kind of interesting, isn't that? When you kind of set out and you pick the right engineering firm, etc., to work with, and it kind of
Which we didn't.
I know you kind of. How do you describe it? So it's a not internal, but it's they've got a different name from Minbos. What's the engineering component?
So we're using. We haven't quite signed the contract with them, so
right.
I don't use their name, but it's a local group that'll do the construction, and we're using our own local owners team with a group from Portugal that are helping out. We had another team from Brazil, and that didn't work out, mainly due to COVID reasons.
Right, so those efficiencies and our settings come through as you've got work things through. So it's a better project now than when you first announced it a couple of years ago.
Yeah. So, and I think one other thing we should say is the major reason it's a better project is we've now got 5 years of field trials invested in Angola. Minbos has now completed more field trials in Angola than anybody, including the FAO and all the UN bodies. And that's really given us and our customers a lot of confidence on how this product works and where it works and why it works. And that was enabled us to change our flow sheet, because we just thought we don't need this complicated flow sheet and product. The raw product is actually working as well, if not better, and it was better.
Okay.
So that's really been the big benefit.
So they just to close off on the money side of things. So IDC is one route. The equities just from markets
plus 1 or 2 little strategic discussions we're having here.
Were they from outside Angola? Or was it all Africa centric?
In bit of both. So we're talking in Africa and outside Africa. But there's a fair bit of appetite inside Africa for this.
Yeah, and we're starting to see that more and more. I think that's fantastic. Yeah, they really do. The straight thing that African banks is good news for everyone in Africa. And there's no sort of legacy issue with the kind of De Santos era, etc. I think in terms of outside people looking in either, is there?
I don't think so. Yeah, and certainly not for our project. I think the big plus of the Lorenzo mandate is he's putting a very, very big focus on agriculture. We know that Angola has one of the stronger economies in sub-Saharan Africa, but it's very concentrated in oil and gas and diamonds. Lorenzo really wants to diversify the economy away from that, and quite simply, 2 million hectares of Brazil-style agriculture will have the same impact on their economy as oil and gas. So it's definitely the right focus. And initiatives like what's been going on with Group Cabinda, and it's $1 billion factory that needs 1 million smallholder farmers to feed it. That looks after all of our offtake almost. So I think it's a wonderful opportunity. It's the fastest growing population in Africa. 45% of the population's under 15. It's got heaps of soil, it has heaps of rain, it's just missing fertiliser and a little bit of education, and it'll just take off.
Right, okay. Contracts, you talked about the sorts of partners that you want to sell into. How does that work?
So we have a memorandum of understanding that goes out, I think, 6 or 7 years with this food aggregator, and we're working very, very closely with them because they've got the same objectives as us. We'll convert that into a contract in the next few months for their benefit and for our benefit. Since the decree came in that says you have to give preference to the local, that favours both of us, because the local market has to buy their product, and they have to buy our product. So it was
at market.
Right. You have to be competitive or near competitive.
Yeah. Who does? You do.
Anybody that wants to take advantage of that. You can't just say, I'm going to be twice the price. You do have to get close to it.
When the market decide, why you're just saying that the market will decide.
Yeah. So
obligation.
If you register your product and you're competitive, then the procedure is they have to come get your permission to import.
Okay.
And your registered product.
Okay. And these term contracts are whatever you agree, is that right? To how long they last?
At the moment, they have a program that they want to fill their factory up, and we've matched that.
Yeah.
And our marketing strategic guys are down there this week talking to them. I'm talking to them on Thursday and refining that. And I expect that will move and change shape over the next 5 to 10 years.
Okay.
But because our product works so well with the segment that they're talking about, I have no doubt that.
Were there any conditions in the debt from IDC as in terms of what they need to see?
Yes, so they want to see that MOU converted into a contract. They want to see the balance of the equity put in place, and they want to see the working capital facility come from the local banks. All of this is well underway. Yeah.
But in terms of the value of those contracts and the time period of the contracts, at least specified that?
We've already seen the MOU, which we published, so they're comfortable with that time frame. And the discussions we're having at the moment are probably likely to make those bigger, if not.
Okay. These are the normal things of debt. I mean, Macquarie is saying that's a pain in the ass, actually. But that's. I just want to understand that. That's all. Because I think the important thing for people looking in at this, certainly your shareholders will be asking the same question. It's like, how do I value this thing, right?
Yeah.
It's not a traditional mining company.
No, it's not. But still, we put a DFS out and things have changed. So we put a DFS out, which put a value on it, which was actually stage 1 and stage 2. I think our stage 1 is almost the same level as the DFS under the current circumstances.
Yeah.
We've made a lot. We've dragged the revenue forward. We've already spent 16, so that's out of the cash flow already. And the capex has come down about 10 million, and we've reduced the transport because we just selected a better site in that time period as well. So, we're looking at an MPB that's almost the same as what our DFS was back in 2022, and we've got an expansion that's like just across the horizon on us.
But I guess this is the interesting bit in terms of we've seen a few companies try to do this in traditional mining companies trying to perhaps position themselves as
company. I'm a nutrient company, Frank.
Nutrient technology, we got it.
So
but
the difference is
not many
we are
comps,
too visible to fail.
Not too many comps. That's the problem. So whether you do a DFS and go my NPV 5, A10 or whatever it looks like this, or I do a DCF and a discounted cash flow and it looks like this, you've got to put yourself in a position to start saying, well, actually, we are a nutrient company, and everyone understands what that means.
So let's step it back and look at the things where we're different, and you might want to be able to explain it to people. So from a mining point of view, we're exactly the same as everybody else. We know what we can put those numbers out. Everybody can analyse those. Look at the capex,
easy breezy
cost. From a revenue side of things, we're looking at a reference price that's very easily published, and our product performs relative to that product, and so it's a very easy reference price. The difficult thing for people to look at is say, what's the market and how many tonnes per year, which you were alluding to before. But now we've got this reference with this, independent food aggregator who's targeting the same market as us and saying, we want to do this whether we've had a Minbos or not. And now they've got a Minbos, so they're quite happy about that. And I think the other thing is the government is also giving reference to that, saying we want to grow our agricultural economy, and we're pouring money in, all hundreds of millions of dollars into the country to promote agriculture in the sector that where we are.
Yeah.
And then there's also independent. So the IFC, for example, is funding the training programs behind our food aggregator. So they are targeting, they're very, very cognizant of the goals that the food aggregator has got. And if you just look at displacing imports, that looks after our market. Beyond that, their population is probably going to double between now and 2050. So it's if you look at fertiliser consumption anywhere in the world, it's always followed population growth. The biggest population growth in the world is going to be in Middle Africa, starting in Angola. So it's, people that want to spend the time will actually look at our stuff and go, that's actually very conservative.
Police products
This is very conservative. And other opportunities, lots of them. So once we finish the P, we're looking at the end. Pea's the most important product. Especially in Angola, it's really deficient in P. It needs P. Don't solve P, can't solve NK. NK don't give you anything. But once you've solved P, N is a very important nutrient for Angola.
Okay. So how do you phase that and grow that? Because cash at the moment, you want to get debt, most of the debt off your book as quickly as possible. So the economics suggests that can happen.
Correct.
Right. We've already been through 3 years of a difficult market, so hopefully not too any more difficult times ahead in terms of movement or availability of cash. That said, equity space is a bit crummy at the moment. Your share price has been hammered, your market has been hammered, and you come from a low base. Is there any opportunity?
Yeah. We're talking into some pretty serious money at the moment, which is good. We also have one of the shareholders in a little trouble for them and got a little bit of hangover, and once that's gone, I think that will.
But you would expect to rotate the shareholder base out, would you? We don't want to, but you'd expect it.
No, we will. We will rotate that out, and I think you'll get interest, as I said, from Africa.
Yeah.
I've had a lot of inquiries in the last 3 weeks from Africa. Bringing the IFDC credit approval then really changed people's perspective of what's actually happening there. And what do we need? $10 million or something like that to actually finish the whole thing off. It's not actually very much money, and most people we're talking to, that's sort of the minimum.
But just remember the simplicity of this thing, because it's clear that the government support is there, and Africa's support more broadly is there. It's a kind of category of one in the sense that it's a pretty good asset, I would argue, to what you've got.
Yeah.
Don't confuse somewhat.
20. Yeah, no. So
it's good for right?
It's a 25-year resource with a 2-year payback.
So it's a big project.
Many of those.
And the money's sorted. And I guess what I'm getting to is, what are the red flags? What are the things that could cause this thing to fall over? What do I need to understand about the market and the ability for you guys to get into production?
Look, I think any shareholder that's been involved with us knows that the thing that it's not actually what the project looks like, it's the speed that you can implement in Angola. So if we've been killed by anything, is we got killed in the last 6 to 8 months not being able to deliver, and we've missed to see. Well, we had the engineer that didn't work out for us. So our guys had to pretty much start again.
Yeah,
and that you can blame COVID, but they just fell apart after COVID and weren't able to deliver on what they wanted to. So we had to start again. So that's just taken time, and that is always the risk in Angola. I've worked in a lot of countries in Africa, and Angola can be a little slower than other countries in Africa.
Okay,
but it also offers more certainty. Your title is, title risk in Angola is very, very solid. And support in Angola is very, very solid. They're very supportive of the incumbent. We once lost the license in Angola. It took a long time. They should have taken it off us a lot quicker.
Yeah,
our partners and performing and that.
Right.
So it's a very slow but sure economy. So the slow is the risk for the shareholders. The sure is not.
So if it doesn't work out, you can go to the uranium game. And by that I mean, folks, extracting uranium.
Yeah. So. Unfortunately,
explain that to people, because I said
a lot of sedimentary phosphate deposits have uranium. Unfortunately for ours, which is actually fortunately, our uranium content is quite low, which means it's actually a very good product to use as a direct application product, but it's not a very good product to suck some uranium out of. And because we don't process it as well, because we get such high grade in the ground, we don't really process it, so we don't have the opportunity to pull the uranium out. So please don't invest in Minbos, because we're going to be a uranium company. we're very, very focused on what we're doing.
Good. Okay, and talk to me about green ammonia.
Good. Once you've got phosphate, you need nitrogen, and Angola has the cheapest hydropower in the world, and we've secured a couple of 100 megawatts at 1 cent a kilowatt hour. So if your viewers understand that, that's the cheapest power in the world. That means you can make very, very competitive ammonia, and ammonia is a source for all the nitrogen fertilisers. I think what we'll see in the next few months is, we've got one project that's really low capex with high returns, and that's a Minbos style project. We're looking at ways where we can structure up the ammonia to do the same thing for us. There's people out there that are interested in doing build, own, operate on the ammonia end, and then we can take the fertiliser end, get the capex way down, keep the returns up nice and high, help Angola, help Minbos shareholders.
I get the economic side of green.
Yeah.
And I guess...
I don't. We're not assuming any premium for green.
Well, that's why I'm asking, because if you are doing this in Canada, you are. Yeah. The OEMs will pay it as well if you're into nickel, copper. But for you guys, given the market you're selling into, there's going to be no premium here.
So it is green ammonia because it's green ammonia. It's zero carbon. But the main reason we're is, and this is just a really cheap way of making nitrogen and making nitrogen fertilizer. So it's just a really good business case.
Yeah.
The fact that it's green is a nice side benefit. That's it. Watch it.
I think that's quite a good summary of, well, certainly I got out of it what I wanted to, is an update on where you're at in the process. And and if I'm being honest about the kind of, I guess the red flags. It's not so sort of onerous thing really. What's happening this year? What do we look forward to this year in terms of moving the story?
So the plan is to start construction in July, and that's based on...
In 2 months' time?
Yep, and that's based on timing, which will have all the product we need, or 90% of the product we need, in our customer sheds by December. So we walk
end
back
of this year, December?
No, December next year.
25,
so for the 25-26 season.
Yeah.
So it got to a point where there was no point running ahead at 1 million miles an hour because we'd missed the planting season for 24-25.
Yeah.
And then so we've got to get there for the planting season 25-26. So we're walking back from December next year, which means we've got to be shipping product in May, we've got to be commissioning in April, we've got to be...
Have you ordered? Have you ordered lead items?
They're already in Cabinda.
They're already in Cabinda.
All of the major
And they're
equipment
yours?
in Cabinda, and they're ours. We already own them.
Okay.
Yeah, so all the major equipment's already there.
And he's building this thing?
It'll be a local Portuguese company. I hadn't signed with them, but the contract's ready to sign and they can mobilise within 2 weeks.
Okay. But it's quite simple stuff, right?
We're doing it in 2 phases. There's the concrete construction, earthworks and civils, followed by the mechanical, and all the mechanical work is all ready to go to tender and be priced as well. All the design's finished on that. And we're already starting, we may actually bring the doubling of capacity into this round.
Okay. And so just on sheds, what's going in terms of the...
Sheds?
Well, you've
got to be there.
Concrete and building. So what's going in it?
So we'll need...
What's the complicated bit?
There's a crusher and a dryer, and it goes into the shed, and then
Crusher,
a
dryer.
port.
Simple. Wow.
Yeah, that's pretty simple.
Crushers.
So there's a granulator and a cooling drum and some double deck screens that we
So
didn't end up using. So we did actually buy some equipment that we won't use.
Right. Okay.
But yeah, watch for 2 years, I think.
The starter stuff. We're not reinventing the wheel here. This is like simple, easy breezy.
When I say crushers,
yeah,
it's a dual speed cage mill, which is sort of taking this thing from 4 millimeters to just 1 millimeter. It's very, very simple.
Good. Okay. Well, I look forward to hearing from you. September when you started all of this process and working way through. Appreciate your time tonight.
That's it.
Cheers.
Cheers. Okay.